It's 6 o'clock in London, it's 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, or good evening, depending where you are in the world. My name is Patrick L. Young, the IPO-VID Livestream. Welcome to Series 18. It's episode 1, which makes a cumulative episode 103, starts here. Fascinating announcement graced both our BitCarnage newsletter. You can get that one via Substack and Exchange Invest, where you can go to our new beta website at exchangeinvest.com. The announcement concerned Settle's capital market business being acquired by Delta Capita from Kolendi of Turkey, while Delta Capita also announced that their anchor tenant, their first client for the new CSD product, Montes, is going to be none other than indeed Montes themselves, as I gave that game away in the sentence. Seven Ridge, meanwhile, they've acquired the American Financial Exchange. All the very, very best to Doc Richard Sander on yet another successful build of a market. Of course, Seven Ridge being heavily backed by SIBO being the early partner of American Financial Exchange as well. What's the future for Ameribor? Well, in the world of SOFR, it's going to be very interesting to see now that we've got an alternative in the financial markets for smaller, medium, intermediate-sized banks. Over at NASDAQ, well, Adina Friedman, she was elevated to chairman and CEO last year, which therefore meant it was highly plausible she was going to abandon a title. She's decided to pass on the mantle, the baton of president, and they're going to be co-presidents now at NASDAQ. All the very, very best to Tal Cohen and Nelson Griggs taking over as co-presidents within the NASDAQ organization. Finally, another little word of congratulation, interim congratulation, I suppose. The interim chairman of the board of the London Metals Exchange is going to be none other than John Williamson, a long-time member of the Hong Kong Exchanges Board who left it a few years back and joined the subsidiary LME board. All the very, very best to him as he takes up his role on the 28th of April as interim chairman. Our guest today, ladies and gentlemen, is Alex Lam. We are talking about real-time risks. Alex Lam is the head of Americas for Scila AB. Alex himself is a long-time veteran of the futures industry technology stack with a long pedigree, including senior roles at TT and RTS Realtime Systems Group, where he sat on the executive board. Alex, it's absolutely a joy to see you in the program today. I give you a very short introduction because we're going to hear much more about your career history in a few seconds. But let's start with the obligatory first question. Where in the world are you today?
I am in sunny, at the moment, Northeast Ohio, though that may change momentarily. Thank you for the kind introduction, and I'm really pleased to be here.
I'm not quite sure which bit is going to change momentarily. Have you got your private jet in the background and you're suddenly going to disappear from Ohio? Or were we talking about the weather there? No, I realize we're talking about the weather because it's Ohio and somewhat changeable as it's in spring. So the one thing is, obviously, a lot of our guests will have already realized that judging from your accent, you don't actually hail from Ohio originally.
Not at all. I'm an African-born Australian who grew up in England and Austria. So that kind of makes me a mutt. So living in America, at the end of it, it just completes the set of A's.
Absolutely. 4A. That's quite remarkable altogether that you managed to get all of those together. Certainly you've been suffering, it seems, alphabetism in the places that you've lived for a lot of your life, actually. So how did that work? You were born where in Africa?
I was born in northern Nigeria, Kano, on the edge of the Sahara, to a father who was a colonial, absent work in the UK. He ended up working on agricultural development and sales out in Nigeria. And then we relocated to Vienna and then subsequently Plymouth as I grew up. And I grew up in Plymouth and moved to London, where I literally jumped in or fell into the commodity business.
Wow, quite incredible altogether. So Plymouth, a very, very historic port city, not so good at the Sachertorte. That was obviously much better in Vienna, but you're perhaps too young to really appreciate it.
Oh, I wasn't. My grandmother had the recipe. So
Excellent, excellent. One of my great theories in life is always that when you're traveling around Europe, you can always tell whose empire somebody was part of by just looking into the window of the cake shops. Because you go to sort of northwestern Italy and you suddenly find that they're all making sacher torta up in the mountains. It's quite fascinating, because obviously you have Austro-Hungarian influence at the appropriate moment. Anyway, so you got to Plymouth. Plymouth's an interesting port town in its own right, and you fell into the commodities business. How exactly did you do that?
As a child, I was a very enthusiastic fan of airplanes, and I intended to fly. So I applied for and got a flying scholarship when I was 17, long before I learned how to drive or ride a motorcycle. And while I was waiting for an Admiralty interview at the end of my last school year, I needed to do something. And one fateful morning, my mother says, "Oh, look, there's a job advertised in the Times, junior in a commodity broker in the city." I'm like, "Oh my God, what do I want to do in the city? I'm going to fly helicopters." Well, at some point I've got to, work while I'm waiting. So I had no date. Off I went. I interviewed. I liked what I saw. My job was going to be in the dealing room as office junior. And I was hooked. And I thought, I can always apply or go back to flying at some point. So we'll see.
There you go. There's always
it.
time on the magnificent plains of Ohio. At least the good news is that you've got lots of airports around you, so there is always that opportunity to manage to restart when you get the opportunity. So you start in the commodities business. You start in the old-fashioned, wondrous British tradition, which predated the modern and I think rather awful concept of graduate trainee programs. You start on the floor, you're doing everything, presumably. I mean, when you start in the floor of your dealing room, you're presumably getting the sandwiches and sorting out all of this sort of nonsense. And how did you elevate? What did you get involved in as your career took off?
My first job was to rationalize, I think, 20 or 30,000 IBM punch cards that were sitting on a desk that nobody had any idea what to do with. Within 2 days of trying to sort those out, I said, "Where are these from?" And I got to speak with a lovely lady at that time, the ICCH, who I still know today, Namid Desak. And we agreed that multiple punch cards were a waste of time. So I started changing this brand new broker's package back office system to make it more user-friendly, because I didn't want to count punch cards for the rest of my life. And as a result, I streamlined the process of daily trade processing to the point where I could actually start moving on to looking after customers, moving money around, monitoring trading, getting trades input intraday, which at that time was a rarity, and making sure we knew whose accounts had what positions at the end of the day, so that the following morning my out trades, as they call them in America, or my unmatched trades that didn't match up on the daily dealing statement, were resolved again before the markets opened. And I thoroughly enjoyed it. It was great fun. Within 6 months, I was running the back office.
How incredible. I'm not surprised, actually, though, if you managed to rationalize that many punch cards, because I can imagine the average commodity broker had no intention of doing it in the morning, and he probably wasn't capable of doing it in the afternoon. So therefore, you filled the gap absolutely elegantly while they had a PFL in the middle in terms of their lunching. I can see that. We're talking about, we're on the road at the moment. We're discussing all sort of aspects of risk. We're through the first of our technology risks, punch card risk, something which is mostly expired at this point in time. Let me say thank you very, very much, Peter Secon. Good evening, gents. He said, "Hello, Peter. I hope you're well. I hope Ari is well as well. It's good to hear from you." And we've got a bevy of messages from Sławomir Krawkowski. Dobry wieczór. I think it's probably going to be the correct thing to say there. Oh, he's asking how are futures on agriculture doing. That's very interesting. And he's also been bemused by we still have punch cards in the US voting system. Well, let's not get to the hanging chad, although given the fact you said you managed to rationalize 3,000 punch cards or something in a couple of days, who knows, the US voting system could be yours yet in 2022. And thank you very much, Sławomir Krawkowski, for your comments. Those are really, really welcome. Alex, I mean, the commodity business in those days, quite incredible. As you say, we had the ICCH, which was, I always thought it's weird that the ICCH, the International Commodities Clearinghouse, was then disassembled and ended up becoming the London Commodity Clearinghouse. And actually, then about 20 years later, it seemed to me reasonably obvious that what we could really do is something like the ICCH, for example, as an international clearinghouse. And of course, they'd already got rid of it, which demonstrates the foresight of some in financial markets, I suppose.
Well, it was mainly bank owned in the early days because nobody had any capital back in the 70s. And as the market started to develop, and I was very fortunate because my CEO, chairman, was a gentleman by the name of Derek Whiting. And he had the foresight to be involved with some fairly interesting people over at Berkshire, not Berkshire, Mercantile House. And so in the summer of '82, I got involved in helping launch Life, which was fun too. So the commodities markets continued to evolve. I think IPE got launched in the late 70s, early 80s. And so everything was transforming. Technology was continuously being improved. And so we had to keep going ahead. And the UK markets were, shall we say, a little backward at that time. But we really sprinted to the forefront in becoming an international derivatives center. When previously we'd really been I would say, probably a quiet player in the derivatives markets compared to the US.
Yeah, it's incredible to look at that. I mean, I always thought it was brilliant. I mean, Sir Brian Williamson always used to tell the story, and still does, reasonably, tell us the story of when they first went to the Bank of England around 1979-80, and the Bank of England saying, we just can't see that there's a marketplace for financial futures. And actually, 18 months after Life was opened, he was invited back round for a cup of tea. And as they were pouring the tea, someone showed him the data that had shown that 2 years before Life opened in 1980, there was actually insufficient liquidity to support a futures market. And then when the futures market was open 18 months, there was actually this incredible bulking out of liquidity in the underlying cash deposit market. And that really was a huge takeoff because obviously London had so many international banks. I know you know all of this sort of stuff, but it's quite fascinating how that all developed. So you were there. This was all exploding. How long did you stay with the commodity brokerage, and where did you go next?
Well, actually, because of my involvement with Life, I moved across from commodities into running the floor operation for an outfit called Confin, which is now Sukden. And part of what I'd learned in that first year when I was actually doing marketing for Life and visiting bankers and explaining to them that their 1/8, 1/4 spreads in the interbank market would narrow up, I realized that there was an opportunity for arbitrage between cash and futures. I'd examined what was happening in the US Eurodollar market, and I figured that the same thing would happen in short sterling. So short sterling was a quiet contract relative to people who wanted to play in the index futures. But it was very, very useful in building out that liquidity, transferring liquidity from the interbank market into the pits. I actually had a client who did an awful lot of arbitrage between Chicago and London in Eurodollars for the first 2 years. So that transfer of activity, that seeking out of opportunities, that acceptance of typical different types of risks that you would get by having a long position, say, in Chicago and a short position in London on what ostensibly looked like the same instrument but wasn't, was actually quite a catalyst to developing flows. So we would literally be pushing 300, 400, 500 contracts in an afternoon between Chicago and London. But otherwise, there was no real outright business. But that flow started to help both markets develop a bit. Later on, I worked as a money broker. I left the commodity firm that I was with and worked for Exco and started looking at interest rate swaps against futures. And again, the same thing happened. The transfer of liquidity from cash positions into futures positions was obvious to see.
Yeah, it's quite incredible, actually, that whole period. I mean, we had Jimmy Olaf last week, the former deputy chairman of the CME, on, and it was interesting because he was talking about the fact that the Life launched a Eurodollar future. The CME had their Eurodollar future already. And actually, the CME was so paranoid about Life potentially taking the business from them that when they looked to extend their hours, they went to Cymex in Singapore and did a deal with them so that they could get a longer trading day. and they felt that that wasn't as competitive as potentially trying to cooperate with London, which they thought might steal the business. It's quite incredible to see how the dynamics were, given the fact that now the Eurodollar reigns supreme, and nobody would dream of the idea that it's leaving the USA.
But what the Eurodollar future fungibility in Singapore actually led to was another episode in my life where I was working in Midland, Hong Kong, and my brief there was to move risk from on-balance sheet to off-balance sheet. And try as I would, I was a lousy trader, but I discovered there was some arbitrage opportunity in the interest rate swap market. So I started pricing interest rate swaps and laying them off on Cymex and then rolling them from either Cymex or CME back into FRAs. Right. And so again, I was transferring what was an interest rate swap risk that perhaps a corporate needed out of Singapore that would call me through a broker, and I would quote, back into Cymex futures. And as a result, I'd be making prices in the back months in Cymex Eurodollars that nobody else was making prices in.
Right.
And I was discovering, shall we say, what I would call price aberration that would result in me adding another 5 to 7 basis points on every FRA trade I did to offset my Eurodollar hedges and actually liquidate profits in the falling interest rate market where most of my futures hedges were longs. So putting cash in the bank and having profitable positions that were back to back was my goal, and I achieved it. It was fun.
It's incredible. I mean, it's so interesting also when you were dealing through that. So the whole environment of the swaps business was all essentially through brokers and then going on to different bank trading floors and straight sort of peer-to-peer transactions. You have the whole business then of the exchanges were all on floors, and it's incredible. I still think it's incredible anyway. Maybe I'm showing my age here, Alex, but what amazes me is just the length to which liquidity is mind-boggling in the short-term interest rate futures. I mean, the Eurodollar going out, I mean, easily you can do strips out pretty much like 10 years or something at the moment. I mean, it's just incredible. Whereas, yes, as you say, once you were through 2 or 3 primary colors, you were starting to run out of road very quickly in a lot of stuff, whether you were on Life or on Cymex, and even the CME, the big daddy of them all, mostly was only going out really a few years in any sort of serious amount of size all day long.
Yes, and coupled with that, I discovered that there was a convergence risk to settlement in Chicago because of the instrument's properties. So to me, owning a Eurodollar future anywhere close to maturity was extremely dangerous. So that's the other reason I looked for a way to roll all of my hedges that I put on every time I put a swap on immediately into an FRA. So I had a LIBOR to LIBOR fixing. So I wasn't ever even exposed to a LIBOR risk because most of my settlements were offset within days of me putting the original trade on. But it meant that I was going through a lot of volume in Eurodollar futures, going out between 6 and 8 delivery months at that time, which was a long way out.
A long way out.
And the further out you got, the further you realized, the more you realized that there was some poor correlation between the forward rates that were implied by the cash markets and the Eurodollar futures in the pit, which were moved by sentiment rather than fair value. Yes, and that was where the opportunity was. Imagine getting a 20 basis point profit on a 1 year fixed against 3 month floating interest rate swap.
It's absolutely astounding. I mean, to get 20 basis points on anything in the interest rate market. I mean, given the fact that what's even more astounding is you think about it, even in those days with interest rates running, I mean, quite possibly in the US, they were running maybe 8 to 10% at various points in time for quite long periods of time. You're still only talking about roughly about 12 ticks of actually daily range in the front month.
Right.
And the idea you could be getting 20 ticks of profit is astounding.
Yeah, I mean, it was paper profit because obviously I was using the compounding model to get the swap to be equivalent. But again, by the time I had the back-to-back and I looked at the offsets and I looked at the net differentials that I had locked in, I was on average making between 15 and 17 basis points per million. And I was doing one of those trades every day. at a time when almost nobody was trading interest rate swaps. The other fun part was I helped standardize interest rate swaps over IMM dates rather than over spot dates, which is how they started to trade when I started trading them in, I guess, late 83. And I needed to calculate my swap prices quickly, and using the Eurodollar prices in my evening or the CYMEX prices in my morning was how I would run them through a little program I built myself to be able to quote them. And then I'd literally call all the brokers and I'd get trades done. It was fun.
It's quite incredible to think about all of these sorts of issues. And I mean, we're here today to talk about real-time risks, and you've identified some fabulous ones. I mean, the punch card risk was one of them. The whole concept of, well, how relatively rarely people were really reconciling positions intraday is the other one at the first stage, which I think would astound a lot of people in electronic markets these days, and particularly floor traders, locals. I mean, they often had outrageous amounts of risk on, and then they suddenly trimmed it all back at the point when they knew it was coming close to the point when their runners were coming by to check what their positions were. And equally, you're talking about the whole instance of the arbitrage opportunities that were just enormous if you understood what you were doing. And then rationalizing the dates. Isn't it fascinating that, I mean, the calendar was not actually something that everybody could agree on? I mean, it seems quite remarkable several hundred years after all sorts of interesting developments by Copernicus, amongst others, that people were still bickering over what date was what effectively. And yes, the IMM gave us the dates of the yield curve essentially.
And basically forced us into a 360-day year, as opposed to a 365-day year.
65-day year, yes.
Crazy, yeah. But
no, it is. I mean, it's quite fascinating. All of these sorts of things are going on, and in fact, we got a kind of retro question or comment coming there. I do believe this is from Lars Grants Rudde. Lars Grants is asking, saying it back to the PFL question. A typical lunch back in those days, did it involve any actual food? Another concept of risk management. I think the answer to that is yes. You had to have something to go in between drinks.
Absolutely. If you were a lightweight like me and you didn't eat, you were toast in the afternoon. There's no way I could keep up. Some of the guys would leave the floor at 11:40 after the UK numbers and come back at 1:20 before the US numbers.
Yes.
And they'd have consumed anywhere between 4 and 6 pints of beer.
I know.
And yet they still functioned amazingly well.
It was remarkable how they functioned, because I agree. I mean, it was simply, I would be entirely dysfunctional after those sorts of lunching occasions. And we have several questions from Sławomir Krokowski. Sławomir, thank you very much. I'm going to address your other questions to go through here, but it's interesting because you're talking about, closing out because you had that risk with the front month in the Eurodollar. And he's just asking, how close to the closing of the positions were you when it was coming to expiry?
In those days, no more than, I wouldn't keep anything open within a month of expiry, because the differential between the paper description of the settlement price structure of the Eurodollar in Chicago, which was based on Chicago banks at the time, compared with London Eurodollar futures, which were based on the London rate that was a call round poll. It was just too unacceptable for me to have that risk between my positions. So I always made sure I had no futures in the nearby month within a month of expiry.
Quite incredible. So really, as soon as the front month was going off, you were essentially out of there and already trying to get into the next month along. That's quite fascinating. Thank you, Sławomir. I'm going to come to your other questions in a moment, but we're just sort of galloping through here. So what happened? I mean, for as long as I've known you, which is 20-something years, well over 25 years and more, you've always been purely on the tech side. Now, you've mentioned dabbling in tech, designing stuff, and so on. So what caused you to make the move from the brokerage side, the trading side, into the world of pure play technology for financial markets?
I can blame FEMAT for that.
Wow.
I was running FEMAT Frankfurt, which was, I think, at that time when I was hired, seen to be a loss leader. I mean, nobody's going to trade just electronic markets on DTB. I mean, it's never going to happen. The fact that I spoke German, the fact that I was, shall we say, I'd spent a year working for a German bank and I had good relationships in Frankfurt, somehow made me the perfect candidate to pick up a tiny little department of SocGen in Frankfurt and turn it into FEMAT. That was basically the eye-opener for me. I'd used other electronic trading systems, Life's APT, and a couple of other things in the past. But what I discovered was that this ability to execute instantly electronically, compared to how long you had to wait for a fill on the trading floor, was just amazing. And so I worked hard with some technologists in Frankfurt. They helped me build a seamless operation. We basically had STP back in '92, same day settlement, no out trades at the end of any day. All of my transactions were posted to GMI in Chicago automatically. All the instrument updates that DTB gave us every day were uploaded into GMI automatically, including the settlement prices. And this was a sea change for the GMI suppliers back then, because nothing prior to that had gone into their systems automatically. It had all been manual. That was Gary Kemp, who became TT's first CEO, who built that for us. And because I had this fully automated, very efficient, relatively low risk business in Frankfurt, when I moved to Chicago, my expectations were very, very high. The reality was I was stepping back not just 10, but maybe 15 years in time. And this was in 97. Sorry, not 97, 95, when I moved to Chicago. And I discovered that we had all these manual processes that were completely flawed, starting with the guy in the pit writing his card, not turning into the guy who worked for another firm whose job it was to get it into a system. So for me, that shock and trying to transform that led me to believe that there were more opportunities for technology. I had a good look at some of the systems that CME had adapted and adopted. I looked at Globex, I looked at Project A, and I felt that there was a massive opportunity to build software, because I, on the side throughout my career, helped influence how software would improve my day. Right. I'd learned a lot in Frankfurt in terms of the functionality of the software that we were dealing with on a day-by-day basis, and how it interlaced with the back office, and how it made my risk management role running a bank in Germany so much more seamless and easy. And here I was in Chicago, and I had no information, nothing real time. If I was lucky, I got a report at the end of the month. I mean, it was pathetic. And so despite my best efforts, I failed to improve FEMAT Chicago. And I left under a cloud in February of '97, or should I say, I got fired. And it was the best thing that happened to me, because I ran into Gary Kemp of TT. We got reacquainted in a supermarket in a northern Chicago suburb. And I helped him transform TT from 14 people, most of whom were in Frankfurt and former East German developers, moved them to Evanston and started building the company as an international business, while at the same time trying to accelerate the growth of the company. And it was so much fun. We became one of the first independent vendors, other than GL, who had an enormous structure behind them at that point, to deliver good quality, and I would call it broker software at that time, rather than trader software. The TT ladder came later. But that was when I was convinced that to be somebody who's been in the business all of my life, switching to the technology just made sense. And there's so much you can do to add to the value of the technology you work with. And the speed at which we're changing that every day is fascinating. And that's why I love this business. It's always changing, and it's always fascinating.
It is always changing and always fascinating. And certainly it was amazing, that ISV business, when it first kicked off, because suddenly lots of exchanges had an electronic component, or opened or went fully electronic, as Life did, and so on, which was a huge boost to the ISV business as a whole, although it took the USA a little while longer to manage to get towards full electronic trading on the floors. But nonetheless, it was quite a revolutionary time. Now, that actually, I think we're going to throw in some questions at this junction, because we've got some fascinating questions. Alex Wilkinson
Hey, Alex, how are you?
Alex. How lovely to see you. He's asking, now there's a fascinating one dating back to your collateralization and the issues with the Eurodollars all the way back in London and Singapore and Chicago. How long before futures markets go fully pre-funded with real-time settlement through the tokenization of cash?
Now, that's a complicated question. Maybe I'm going to have to hand that one over to you, Patrick.
Well, actually, what I was going to say was, it's very interesting. I ran Cybex, the second stock exchange in Romania and Transylvania, and that's over 10 years ago. And we thought we were really smart because we had real-time, effectively pre-risk management, and you couldn't put a trade in unless you had sufficient money in the account that could then be set aside to meet the margin that was coming up. And we thought we were so cool and so amazing. And then I was talking to somebody a while later, and he said, oh no, actually, there was a Chinese futures exchange did that in 1994, which was actually at the point in time when, you would remember it well, all these Chinese exchanges exploded onto the market, and it was just too early for the Chinese Communist Party to deal with them. So they effectively closed them all down again and had a pause of about 5 or 6 years in a hiatus, and then they restarted the exchange business. So there's almost nothing new under the sun. So to a certain degree, there are some exchanges that are already fully pre-funding in some way, shape, or form. The tokenization of cash, Alex, I'm almost inclined to say, Alex Wilkinson, why don't you come on this show and explain yourself? Because I think there's a great conversation to be had there, Alex, and it would be really, really interesting to discuss, because I think the answer is that certainly if you go from one extreme, and here we are talking about risk, you've got that whole scenario we were talking about where floor traders used to just build up ridiculous positions as locals when they were only supposed to have 5 or 10 or 20 lots, and they could quite often have a couple of hundred. And then they would trim it all back when they were coming close to whatever was the next period of reconciliation. And yet, now we're in a situation where people effectively, at least their brokers, are trying to stop them doing too many trades. Right. But the exchanges aren't necessarily too hot on it. It's quite fascinating.
Absolutely. I think Alex is onto a thing here, because my feeling is it shouldn't be too long. The ability to link cash and tie cash up within a concert, within this whole ecosystem of a transaction, which is dynamic and changing in value continuously, you want to be certain that you're fully funded, because you want to guarantee everybody's performance. So I don't think it's going to be too long. I think we're going to see some good changes. How it takes place and how the mechanisms are well enough understood by a broad sector of the market is marketing. It's going to have to require an awful lot of effort by an awful lot of people to get the message across. But I think it's going to happen.
Yes, and it's also quite fascinating, because then when you come into the tokenization realm, all very good, but it still has quite a huge latency. And you think about it, T+2 is what's a day, 17,000 seconds or something like that. So therefore, you have a huge number of seconds of latency for even T+2 settlement. And I know that various people are trying to work their way in on that in cash markets. But then you go to sort of blockchains, and people go, well, they're great because they're real-time settlement. You go, well, not necessarily. The Bitcoin blockchain averages like 450 seconds. And then you take a company like Hanmag, is always my favorite example, in Korea, which went from having a positive balance sheet of 50 million to minus 50 million in, I think, 125 seconds before somebody managed to switch the robot off that had gone completely ballistic. And that was 10 years ago, which I suppose actually brings me, thank you very, very much, Alex Wilkinson. I love that question. Yeah, it's really interesting. But let's get in touch. I'd love to get you on the show to actually talk about that, because we had a question earlier, which I didn't introduce. Sławomir Krokowski, thank you very much for waiting to hear this question. He said, can you make any insight into AI replacing us as market analysts? Aren't you afraid we would all be obsolete in a few years' time?
Well, as long as it's maybe 10 years' time, I don't care. No, I'm joking. I don't think AI is going to replace us. I think there is always going to be a human element. If we go back to my example of mispricing of Eurodollar futures in markets, mathematically, you can say, well, this is the right price, so we should all converge to that price. But there will be so many human beings still intervening. You're not going to be able to displace the market using a machine, I don't think. And I also don't think that AI is going to be let loose in any kind of uncontrolled, unsupervised manner for a while yet. Market analysts, I think an awful lot of data is already being analyzed by AI, but at the end of the day, you're still going to have to make an educated guess, however much data you have. And the beauty of data is you can't have it all. You have to also hope that you've got as much as you need to make a decision. And the nice thing about AI is it probably will continue to ratchet itself through 1 million, 10 million, 100 billion cycles, trying to get to the right answer. And that's where computers don't say enough is enough.
No, I think that's true. And I think that's a very, very interesting point in terms of how actually humans can outthink AI. I think it isn't the point. It's really a bit like the difference between essentially, well, dominoes, for example, not dominoes, checkers, were for a long year drafts in Europe, where for a long time it was patently obvious that a computer would very soon be the ultimate champion. And yet you look to this day and humans are still outperforming the best computers at chess most of the time. And the amount of work that has to be done to make a chess computer beat a grandmaster actually involves putting the computer in a room with about 5 other grandmasters in order to help it. Now, of course, we know those things will change, but nonetheless, there's a point at which you can think outside the box. And I think that's the point that the machines are going to do different. It strikes me where AI for analysts work really well is in getting generally synthesized numbers. I mean, you don't have to sit there and come up with, oh, this is the average for that sector, because a computer can go off and do that with AI and then start tweaking the model. But a very, very interesting question nonetheless. And thank you very much, Alex Wilkinson. He's, first of all, he's saying he's all good, gents. Well, that's great to hear altogether. Thank you, Alex. And he was saying, yes, indeed, when he's talking about tokenized cash, he's saying it should have 0 latency, which is quite sensational. Got a question here from coming in fast and thick. Connor Power, from a tech perspective, do we foresee a tougher fundraising environment becoming the new norm? And can the Fed continue to hike in the medium term? My goodness, you didn't think you'd be getting to microeconomics. You mentioned interest rates. Now they're asking you to opine on them rather than arbitrage them, Alex.
Hurry up and put your money on deposit and lock it in fixed, because rates will be coming down soon. No, I don't know the answer to that. I do think that the fundraising will look at the value, or should I say the certainty of higher interest rates as an opportunity to, shall we say, make more money on a lot of money. There still is an awful lot of money in the hands of very few people that needs a place to be invested. So I honestly believe that the best tech firms out there will still see a lot of money flowing to those firms, particularly if they're looking at or appear to be showing themselves as being a better nutcracker for a particular problem. I don't think the Fed will continue to hike. This inflationary cycle that we've seen has been very driven by excessive, in my opinion, commodity speculation, particularly on the input side of commodities. Always happens before a war, always happens into the beginning of a war. The difference here is the consumers are not busy pushing prices up. So I think we're going to see prices abate as competition for customers will kick back in again, rather than, shall we say, big margins that can be easily sustained in the short term, but not in the long term. So I think the Fed will keep its eye on inflation. The numbers I've seen just today of big drops in commodity prices make me believe that we've got to be careful we don't end up deflationary.
Yes, it could be quite fascinating, because the central banks, all having been slow on the way up, could be incredibly quick moving and suddenly find themselves quite out of the. Yes, it's a fascinating possibility for the future. Thank you very much for that question, Connor Power. And I think the answer to this I could probably guess, but actually no, I've hit the wrong question. Sławomir Krakowski, did you get any experience with futures in cryptos?
Not personally. I think the big challenge with cryptos is the underlying. The understanding of the underlying is so fragmented. I mean, how many coins are we talking about today? 10,000 plus. How do you describe those coins? How do you really find a fair value for something that is not, shall we say, common? because none of these are common with the exception of the big ones like Bitcoin and Ether. So I have decided to stay away for the time being, personally. Yes, our firm that deals in risk management systems has a lot of experience in cryptos, in monitoring the transactions and making sure that risks are controlled. But the big challenge is that interface between cryptos and real fiat money. I won't say real because it is fiat money as opposed to cryptos which are not fiat money. I think there is a future for these products. I just don't know if I could comment to exactly in which direction, but whatever happens, they have to be regulated and they have to be very, very visible in how they behave and who clears them and who owns the platforms that they're on and how those platforms behave, as FTX shows us.
And in fact, on that point, we've got a perfect dovetail there because we've got Martin Watkins, and we started the show, of course, talking about Martin Watkins. He's CEO of Montes, who've just put in for Settle as their new vendor for their system for crypto and digital assets. And he's saying, Patrick Young, exciting times await as the target addressable market for tokens dwarfs existing capital markets. Thank you for your input, Martin. Much appreciated altogether. So let's get back to where you've been and what you've been doing. I mean, you had a long time where you worked in essentially the front end of the vendor business. I mean, you were TT, then you were RTS, which was obviously an amazing, remarkable German firm that was built up from nothing by a father and son team and became worldwide. And I think you were on actually the executive committee there, or you were on the board there that eventually, weren't you?
I was. In between TT and RTS were two ventures. One was a year with Easy Screen, which was very interesting. And anybody in the UK market will know what I mean by that. It's a pity because Easy Screen's technology and technologists, who were eventually acquired by Marex, was extremely good. It was a great product, great platform, but unfortunately poorly managed. I think back to the earlier question from my colleague Les Grants, our executive team were too busy in the pub. But I then moved to, I spent some time in that little gap between those two companies working for Goldenberg Hamer, which was a prop shop that most people haven't heard of. But at one point, it was one of Eurex's biggest arbitrage members. So trading everything on the yield curve in the German markets, but also an extremely big bond basis trading house. And I was intimately involved in building a bond basis platform. So trading cash bonds on eSpeed BrokerTec against bond futures on the CBOT and Eurodollar futures on the CME, and at the same time, the German markets all on the same platform. And that was my first real venture into near real-time risk dashboards. And so as part of building that trading platform, I also built a very nice little browser-based front end to monitor every trader, every trading group, and every office's risk continuously. And that was probably one of the most fun, again, everything's fun, but probably one of the most interesting projects for me because, again, it went back to my fundamentals, which I learned back in my youth. The back office is key to everything that goes on in the front office. And because we took that decision, that product was extremely useful in building profits for the firm. So yeah, so I actually built stuff based on, or should I say, managed building stuff, because I had much better programmers than I ever would have been, by learning from the mistakes that I'd seen made at TT in the early days. By looking at what other competitors had come up with, and by understanding the business needs of the traders and the trader managers, we put together a great system that made, I think, Goldenberg Hamer very much more valuable, and kept that technology going on in Penson for many years beyond that. But yeah, RTS was fun too, because I went into a screen company and helped them transform that into a market access company, which eventually resulted in them being sold to Bloomberg. And again, the key there was opening up the platform, open APIs, let the traders build their own applications, give them the lowest possible latency with the least connectivity headache. But at the same time, monitor what's going on in that common layer so that everybody who's accessing the markets through that common layer can see the risk. So the ability to then look at the risk and display it on the screen was something I recognized. RTS at the time didn't do it. So I chatted with a friend of mine who ended up building a product that ended up being bought by KRM22 of all people, because there was no real-time dashboard for monitoring risk across multiple markets other than snapshots from a back office, which meant it was always late.
But it's incredible to think how not joined up all of the risk approach was. I mean, for so many years. And in fact, that I think dovetails neatly into another question from Martin Watkins. Thank you so much, Martin. Throughout your career, Alex, where have you seen the strongest will to innovate and use new tech in the exchange and trading business from the 1970s until now?
Where specifically? I can't be specific. I think the key element that's always been the driver is profit. If we weren't capitalists, we wouldn't do half of the things that we've achieved. What I think has happened is the technologists have moved so close to the business people and the business people so close to the technologists that this cross-flow of information and ideas is better now than ever before, and technology has obviously enabled that to be even better. I sit here in Ohio and I work with my colleagues in Sweden, and we share ideas and we talk about stuff both on the phone, in a video call like this, or electronically through other tools. And I think that is one of the biggest developments, this move from, gee, I need a system, it's got to fit this spec, to I know I have to have certain tools in place. How can I make them more useful to me? And how can I make them help me make money? So my view on risk is what we take to make money, but we need to understand every little piece of it. And I also think we're going to start seeing the move towards risk and behavioral monitoring coalescing. In other words, if the trader's having a bad day and losing money, pops up in the risk platform, now you're going to be keeping an eye on him in the surveillance and market behavior platform, because it's quite likely he's going to do something stupid. And vice versa. Somebody doing something stupid presents you with massive risk. And I think we will see this blending of middle office, front office monitoring more and more, where one shall we say, data source delivers all kinds of value through different user applications. And again, those
very interesting. I mean, when you look at risk, I think when we sort of started, risk was something which essentially involved like a cuckoo clock, somebody appearing and saying, no, you shouldn't be doing that. Whereas now, risk has become so much more granular, and people are saying, aha, on the horizon, if you keep doing that, you're going to have a problem. Or if all the people do this, or everybody's trying to go the same direction all at once, therefore that has a holistic problem for the bank, as opposed to previously it was incredibly spotty, both in terms of how joined up it was and how granular the thinking went.
Yeah, my experience in building the risk front end in concert with the trading front end for Goldenberg Hamer really got me to understand how trader managers, now that they're informed with what their traders are doing, could see a trader having a great day and stop him trading anymore once he was up, because 9 times out of 10, the big up days, which were unusual, led to traders having big ego days, leading to the biggest down days. And so the value on that kind of isolated by account viewpoint was huge. But what you just said, which is the concentration of exposure in any direction, that became more obvious as well as things started to become more and more captured in real time. So yes, how you look at risk, how you look at the behavior within risk is much more sophisticated. I think the interactions between asset classes is still underutilized. We think we know how X behaves with regard to Y, but what about A, B, C, D, and E with regard to X, Y, and Z? How do those different elements influence each other? And I think risk managers, good risk managers, are going to be looking for those links, those dislocations, and trying to understand historically how they impact their potential for unwanted risk. Wanted risk is good, unwanted risk is bad. And so that I think is what's going to happen more and more is the creativity of the human mind. And again, the human mind tends to think outside of the box rather than in any kind of pre-programmed way, is going to lead us to, again, massive innovation. And I think if you look at how trading systems are super complicated and super sophisticated and super easy to use today, I don't think they're done. But compared to where we are in the risk management and the surveillance space, I think there's an awful lot still to be done. And I think this coming together of risk and surveillance, the ability to slice and dice masses of data and to analyze that data and then look at other factors that you're continuously generating. So, for example, a good risk management system should continuously stress test and do value at risk tests on every position, and those tests, those worst outcomes or near worst outcomes, should generate alerts so that people go and look at the risk that this potentially unexpected market move could saddle me with. Because market moves, you can't do much about those, and yet everybody seems to accept that they're going to happen. But yeah, there's an element of being able to look ahead, see how the market moves, that your stress test model, which could be varied by instrument continuously, tells you. And then you can go back and say, you know what, I'm going to run this new stress test model that I've just changed on all the data going back and see whether it would have helped me stop somebody, save something, looking back at the last 5 years data. So it's going to be quite interesting.
Fascinating, really intriguing. I'm going to ping you with two quick questions before we go in the last 2 minutes. So Sławomir Krakowski is asking, are you seeing the future of the future of gold in the sale of intangible assets? And actually, I'm going to tie that in with another, which is, tell us how Russia is trying to influence global markets from your perspective. Can we stop them from influencing gas and energy commodity prices? Not sure that those are either right up your street, but I'm sure you're going to have something interesting to say.
As a former arbitrager, where the fungibility of instruments or the deliverability of instruments does make a difference, it still baffles me that without, shall we say, some market manipulation, why the price of power in Europe went to 10 times the input price of the components of that power. So is Russia influencing global markets? I think they're doing more to influence global markets through social media than they can in influencing the trading markets, because the trading markets are quite well policed. So I think in Europe, gas and energy commodity prices are probably more influenced by badly behaved traders than necessarily the impact that a shortage of gas because of the threats of the Russians had. In fact, I think Germany did extremely well, because I think Germany is probably the biggest energy consumer in Europe. And again, anyone can correct me, in managing to transition themselves away from that Russian supply and adapt the way they used power and used gas in order to continue doing business. Again, as with trading, electronic trading from pit trading, this willingness to adapt and to adapt really rapidly, I think is going to reduce the risk that we're going to see from bad actors. Gold, frankly, I think water's the next big commodity. Forget gold. You can't drink it, you can't eat it. It's very heavy to carry, and today people would like to steal it from you. Water's very difficult to take away, but without it you can't live. So I actually think that water as a commodity is undervalued, undertraded, undermanaged, and I think, and I've thought this actually for probably the last 30 years. So I expect big things in terms of water. I actually think renewable energies will become more and more important, not because governments dictate it, but because people understand that they can operate and they can be used. So I see, again, a lot of change, a lot of risk.
Well, it's very interesting, actually, because I think the renewable energy thing, absolutely. And I mean, Martin Watkins was talking earlier about total addressable market from tokens. I mean, the total addressable market from renewable energy and related things is absolutely vast. It's quite incredible. And well, I'm with you on water. In fact, in the January 1st issue of the Futures Industry Association's magazine, Futures Industry, I actually had an article that was January 1st, 2000 AD, and what the world would be doing in 2020. And I got it wrong because I said that we would have an incredible opportunity where water was the biggest traded commodity in the world. Well, I got that wrong, but I still think I'm with you. I think our time will come for water trading in the near future. So, you know, you've been through this incredible life in risk, this incredible life in ongoing revolution, upturns in markets. Throughout it, there's been a heavy theme of technology. Alex Lamb, where do you think the capital market revolution goes next?
I actually see this. Everybody says, well, crypto's it. I actually see barter markets as it. Reducing the why do we continue to transfer an asset between two assets when we could just transfer the asset ownership efficiently today using technology? So I think transferring assets without necessarily having to involve cash or tokens could be the next step. There you go.
How fascinating. The total disintermediation of money itself. What an interesting concept, and one which I think will be debated for a great deal of time to come. Well, Alex Lamb, it's been absolutely a joy to be here to be discussing the incredible issues of risk, all the way from very not real time to incredibly real time and increasingly holistic. But there's still a long way to go, a huge world of opportunity there. Thank you very much to all of the people who participated in the show today. I hope I managed to remember you all. Martin Watkins, actually, who says excellent IPO-VID, Patrick Young and Alex Lamb. Great insights. Best from Martin Watkins. Thank you very much, Martin. Absolutely excellent altogether. Thank you, Peter Sekon. Thank you, Sławomir Krakowski. Dziękuję bardzo. Lars-Göran Ruda, Alex Wilkinson, Connor Power, Martin Watkins once again. Thank you to our production team, Herminia, Rushelin, and Natalie. Next week, we are going to have an absolutely fascinating guest, which is going to be, we're going to be in defense of capitalism, and that's going to be with the multiple best-selling author, and all of them somehow or other about free markets, finance, entrepreneurship, and capitalism in general, Rainer Zittelmann. That's same place, same time. It only remains for me to say thank you once again to Alex Lamb, who's the Director of Americas for Scila. They're people who do all sorts of wonderful and incredible things on the holistic risk front for from your surveillance to many other things beside. My name is Patrick L. Young. Thank you very much for watching this show. I wish you all a great week in blockchain, life, and markets.
Thank you.
You're welcome.